Russia cuts to 17%, inflation persists. Drones, sanctions choke fuel, costly reroutes. U.S. gas near $3, refiners win.
Rate cuts, refinery chaos, and a quiet sanctions squeeze. Here's what the headlines won't tell you. When a central bank slashes rates and in the same breath admits price growth is still running hot, that's not mission accomplished. That's triage. On September 12th, the Bank of Russia cut its key rate by 100 basis points to 17% and conceded that underlying price growth remains above 4% annualized, with inflation expectations still high. That is a wartime economy blinking, not boasting. Governor Elvira Nabiulina's follow-up only sharpens the picture. Seasonally adjusted price growth around 4% annualized, expectations elevated for households and firms, and export-oriented sectors cooling. Translation for anyone not paid to spin this: rate policy is running uphill against sticky inflation and a weakening external backdrop. Now layer in the punch the market felt first: refineries and ports. After drone strikes, Russia is scrambling to reroute exports, upping plans at Ust-Luga and Novorossiysk, while Primorsk faces delays. You can keep volumes stable on paper and still bleed cash through longer voyages, pricier freight, and idle tankers. That is the difference between headlines and cash flow. Inside Russia, the pain is already retail. Wholesale petrol prices set records in late August and regional shortages surfaced. Price controls can hide symptoms for a moment, but they don't rebuild damaged capacity or reopen smooth supply lines. Households feel the squeeze first, and they vote with their wallets long before they ever march in the streets. And the financial plumbing? It's tightening by design. Washington's secondary sanctions push is aimed at the banks that keep Russia's war economy liquid, raising risk premia on every cross-border ruble and scaring compliance teams into over-delivering. You don't need a ban to throttle a system. You just need enough paperwork to make every transaction hurt. Here's the twist American drivers actually care about. This doesn't automatically mean $6 gas. The EIA's latest outlook still pegs U.S. regular gasoline at about $3.10 per gallon in 2025 and $2.90 in 2026. Why? Because U.S. pump prices are steered more by refining margins, inventories, and seasonality than by distant crude drama. In other words, Russia's refinery headaches can widen crack spreads and fatten U.S. refiner margins, while the retail price tag barely budges. That's the part the nightly news won't spell out. If the cut was the siren, the diagnosis is deeper: a central bank out of easy options, a budget trying to outrun oil, export arteries under stress, and a sanctions tourniquet tightening quietly. Buckle up. We're going to follow the money, not the talking points. Stagflation trap. The Kremlin's rate cut signals weakness, not relief. Start with the inconvenient fact. When a central bank cuts to 17% and still admits underlying price growth is running above 4% annualized, you're not watching confidence. You're watching containment. On September 12th, the Bank of Russia trimmed the key rate by 100 basis points and in the same release flagged that inflation expectations remain elevated. That's a "we had to do something" move, not a "we've got this" moment. Governor Elvira Nabiulina's follow-up makes the subtext explicit. External demand is cooling, uncertainty about fiscal policy persists, corporate lending is speeding up for the wrong reasons, and expectations refuse to break. In plain English, the credit machine is humming while disinflation drags. Classic wartime rate transmission fatigue. Here's why that matters. High policy rates should crush demand and cool prices, but command lending, subsidies, and directed credit keep headline loan growth alive while underlying inflation proves sticky. The bank itself says the current price growth metrics remain above 4% annualized, meaning the patient still has a fever even after another dose. Now, the ruble problem. A cut like this can weaken the currency via expectations, which then feeds back into prices through import channels. You've seen this movie: a softer ruble, higher pass-through, and the same central bank forced to choose between retightening later or slapping on new administrative controls. That's not monetary sovereignty. That's policy ping-pong. If you're tracking this professionally, stop arguing narratives and start watching signals. Follow the policy rate minus CPI gap and ruble implied volatility. If the real policy rate compresses while FX vol pops, the next acts are predictable: tighter FX/admin controls, export levies to defend the balance, and more pressure on households through the back door. And don't pretend this is happening in a vacuum. Refinery and port disruptions are forcing Russia to reroute flows from Primorsk to Ust-Luga and Novorossiysk, keeping export volumes stable by papering over growing logistical cost and fragility. Monetary easing against that backdrop looks less like strategy and more like firefighting. Bottom line, the rate cut isn't relief, it's a tell. Elevated expectations, slowing external demand, and wartime credit distortions are cornering policy. When a central bank blinks while the energy arteries are under attack, you don't price in stability, you price in strain. Next, follow the money to the federal ledger and you'll see why deficits are starting to outrun oil. War budget bleed, deficits outrun oil. Start with the ledger, not the slogans. By July, Russia's federal budget deficit had swollen to roughly 4.88 to 4.9 trillion, already overshooting the year's glide path and forcing a political choice: cut the civilian economy, raise taxes into a slowdown, or borrow at fatter risk premia. That isn't resilience. That's fiscal triage. Moscow's answer so far is to reshuffle the rulebook. The finance ministry is de-oiling the budget rule, ratcheting down the cutoff oil price each year to signal less dependence on hydrocarbons. Signal is the key word. If the economy truly had a diversified cushion, you wouldn't need to retrofit the rule mid-war to prove it. The spending side tells the real story. Defense and security are now a Cold War scale line item, with Kremlin insiders openly calling the forthcoming framework a wartime budget. Social promises must be kept, we're told, while the deficit forecast drifts wider and growth slows. Guns over butter isn't a metaphor anymore, it's the model. Here's the mechanics behind the bleed. A stronger ruble and patches of softer crude mean fewer rubles per exported barrel. Add refinery damage and port delays, and each month squeezes domestic fuel supply and tax take. Even if export volumes look stable on paper, it's not just price. It's base effects eroding revenue, while expenditure refuses to blink. And the financing pipes are tightening by design. U.S. Treasury's secondary sanctions campaign raises the compliance temperature for any foreign bank touching Russia's military-industrial flows. You don't need to sanction a country to raise its borrowing costs. You only need to make every letter of credit, every insurance line, every correspondent link more expensive and slower. That is a stealth tax on the budget. So position this plainly. If deficits outrun oil, Moscow either slashes civilian capex, lifts taxes, or cannibalizes reserves while paying up for funding. For investors, that means import substitution winners with non-Western supply lines on one side, and structural losers where Western components are irreplaceable, machine tools, advanced chips, on the other. For citizens, it means the bill arrives through inflation, shortages, or deferred services. The spreadsheet always balances. The question is whose balance it torches to get there. Refinery wars, Ukraine targets, Russia's fuel arteries, global product markets flinch. Starting risk, supply chain choke. Russia is trying to look calm while its fuel arteries spasm. After deep strike drone hits, Moscow is rerouting exports away from Primorsk and lifting planned loadings at Ust-Luga and Novorossiysk just to keep barrels moving. On paper, that stabilizes volumes. In practice, it layers on longer voyages, scarce tankers, and fragile schedules, hidden costs that don't show up in the headline export number. Hidden mechanism, products greater than crude, disabling refining bites harder than nicking crude supply. Knock out distillation and upgrading units, and you tighten gasoline/diesel balances even if Brent is range-bound. That's exactly what the last week's delivered. Record offline refining capacity and fresh outages as drones repeatedly hit large plants from the Baltic to Bashkortostan. The result isn't just less product, it's wider crack spreads as traders pay up for molecules they actually need. Analysts are blunt. Goldman Sachs estimates roughly 300,000 barrels per day of Russian refining capacity was knocked offline in August, and so far in September, a product market shock with outsized price impact. When refiners, not drillers, are in crisis, the market stops caring about crude abundance and starts bidding for finished fuels. Counterintuitive twist, U.S. refiners can be the relative winners here. If Brent stays capped by macro and OPEC plus discipline, while Russian product output sputters, the cracks widen, lifting margins in the Gulf Coast even as the headline crude tape looks sleepy. That's how you get bullish refiner profits without a crude rally. Do this now. Product-led hedging. Stop treating WTI as your only hedge. If you're a driver, a small fleet, or an investor, watch the 3 to 2 to 1 and ULSD/RBOB cracks, not just Brent. Monitor Gulf Coast utilization and outages in PADD3. That's where the real retail story begins and ends. In a refinery-led shock, RBOB or ULSD call spreads are a cleaner protection than an outright crude bet. Meanwhile, inside Russia, the downstream pain is visible. Record wholesale petrol prices in late August, regional shortages, and ad hoc export bans that paper over the damage rather than fix it. Analogy: cut the arteries, not the heart. In oil, products are the circulatory system. You can keep the heart beating, but if the arteries are narrowed or severed, the body staggers. That's the market you're living in now. Crude looks fine. Gasoline and diesel do the screaming. Secondary sanctions, the quiet strangler of Russian cash flows. Starting risk, financial plumbing pressure. Washington isn't chasing headlines, it's squeezing the pipes. Treasury's campaign now explicitly targets foreign financial institutions that touch Russia's military-industrial flows, warning that providing material assistance can trigger full blocking sanctions. That raises the risk premium on every cross-border ruble and turns ordinary transactions into legal minefields. Hidden mechanism, compliance chilling effect. You don't have to sanction India or the Gulf to slow the money. You just have to make compliance officers nervous. The OFAC advisory spells it out. Correspondent banking, trade finance, and even facilitation for sanctioned entities can put a bank in the firing line. Result: letters of credit get pricier, insurance gets pickier, and settlement stretches from days to weeks. That is monetary friction masquerading as paperwork. Counterintuitive twist: paper can bite like a tariff. The story many repeat: cheap Russian barrels will keep flooding Asia, ignores the cost of the paperwork gauntlet. As sanctions enforcement tightens, more cargoes move via older shadow tankers with murkier ownership and insurance. Analysts tracking these flows show the share of sanctioned or shadow vessels rising in mid-2025, with a meaningful slice of volumes riding vessels already under sanctions exposure, an operational tax that widens discounts and delays receipts even when tonnage still sails. Do this now. Monitor the pipes, not the press releases. Watch for P&I insurance refusals, LOC pricing and tenor into India and the Middle East for Russian cargoes, and day rates for the shadow fleet. A tightening in any of these channels is your early warning for bigger Urals discounts, slower settlements, and more volatile product markets as traders demand compensation for legal and operational risk. Pair that with Treasury's step-ups against third-country evasion, and you have a policy that constricts cash flow without announcing a ban. Analogy: arterial plaque in global payments. No dramatic blockade, no single headline, just a steady buildup that narrows the flow until the system wheezes. Banks overcomply, freight migrates to older hulls, insurance carves new exclusions, and every ruble that crosses a border pays a toll. That's how you strangle an economy quietly, with forms, not fireworks. U.S. gas prices. Why Russia shock equals $6 gas is mostly a myth for now. Starting risk. Headline anxiety. Attacks on Russian energy raise fears of a U.S. pump price spike, but the EIA baseline shows 2025 average approximately $3.10 per gallon, drifting below $3 in 2026, barring a true export shock. Hidden mechanism, cracks and seasonality. U.S. prices hinge on refining margins, inventories, and demand, not just Brent. As fall demand eases, AAA shows softening week over week. Counterintuitive twist: Russia's refinery outages can boost U.S. refiner margins even as U.S. retail stays contained, particularly if crude stays capped by OPEC plus policy and soft macro. Do this now. Personal Finance Playbook. Households time bulk fuel buys ahead of regional refinery maintenance windows. Small fleets use fixed forward purchasing tied to RBOB basis instead of pump averages. Investors prefer refiner equities/MLPS over upstream for Russia-specific shocks. Analogy: think grocery bill. A strike at a faraway cannery raises canned goods prices, not raw tomatoes, refining tightness not equal to crude spike. Here's the sober math the nightly news skips. The EIA's September outlook not only pins average regular gasoline at about $3.10 per gallon in 2025 and $2.90 in 2026, it also notes that drivers' gasoline spending is likely to be the lowest share of disposable income since 2005, excluding 2020. When the balance of forces is falling crude, ample inventories, and easing seasonal demand, the pump price follows the refining cycle, not the loudest headline from the Baltic. Bottom line, worry less about viral maps and more about crack spreads, inventories, and maintenance season. If the product market tightens while crude drifts, refiners get paid and consumers barely notice. Annoying for pundits, useful for your wallet. Export reroute. Math. When infrastructure damage meets tanker logistics. Start with the new map of risk. After drone strikes snarled Primorsk, Russia is shifting loadings to Ust-Luga and Novorossiysk to keep headline exports looking stable. That sounds tidy until you hit the operational ceiling. Limited tanker availability, pumping constraints, and port bottlenecks that turn every extra mile into demurrage and lost netbacks. Stability on paper, leakage in cash. Throughput isn't a light switch. Draft limits, storage capacity, and line pack define how much you can actually push through an alternative port, and ice-class dynamics in the Baltic only sharpen those constraints as seasons turn. Reuters' tally has Ust-Luga and Novorossiysk loadings revised up precisely because Primorsk faced delays, but even that reroute is bounded by ships and steel, not willpower. The condensate case study says the quiet part out loud. Novatek has had to redirect approximately 70,000 tons of gas condensate to Novorossiysk after the Ust-Luga complex shutdown, a workaround that keeps barrels moving but blends away value and adds voyage time. Workarounds aren't free, they're a stealth levy on the budget. So read the tells, not the press releases. AIS dwell times rising, ship-to-ship transfers multiplying, Baltic freight rates jumping. Those are the dashboard lights that come on when reroutes hit physical limits. Even if total export volume prints unchanged, there's hidden costs. Idle time, longer hauls, older hulls eat into fiscal capacity and widen discounts on the barrel. The market outcome is simple and uncomfortable. Wider differentials for Russian grades and a more jittery diesel/gasoline crack as traders price the probability of yet another outage or port delay. In energy, distance is money and time is risk. Russia just got more of both. From full war economy to public fatigue, the social side of macro slippage. Start with the part of the technocrats downplay. Households. When petrol prices set records and shortages ripple across regions, you can quote all the balanced growth lines you want. People believe the pump. Late August brought record wholesale petrol prices and documented shortages after repeated strikes on major refineries. That wasn't a mood swing. It was a supply shock ricocheting into daily life. The strikes didn't stop at refineries. By mid-September, Ukrainian drones hit Primorsk, Russia's biggest oil port, damaging tankers and forcing more emergency workarounds. Every detour and delay leaks confidence from the consumer side because nothing says solid macro like empty forecourts and rationing whispers. Now overlay the central bank's own diagnosis. On September 12th, the Bank of Russia cut the key rate to 17%, while acknowledging that underlying price growth is still above 4% annualized and that inflation expectations remain high. Translate the euphemism. People expect prices to keep rising, so they bring demand forward when they can, and hunker down when they can't. In both cases, the budget's tax base gets weaker, not stronger. This is why full war economy can lose economic initiative even as spending soars. Diverting resources from civilian sectors to defense props up industrial prints in the short run, but starves productivity and innovation spillovers, the compounding effects that keep real wages ahead of the checkout line. Once expectations de-anchor and the fuel line jitters, policy fixes get more administrative. Price caps, export bans, surprise inspections. Each patch is a confession that macro pressure has reached street level. If you want forward signals, not propaganda, watch three things. First, retail fuel interventions. The more frequent and geographically broad they become, the thinner the margin for error. Second, regional protest indicators and municipal temporary measures. When local authorities turn to ad hoc rules, the center is firefighting. Third, the Bank of Russia's language on expectations. If they keep stressing elevated expectations after a rate cut, it means the public isn't buying the disinflation story. Put bluntly, morale is an economic resource, and Russia is spending it faster than it admits. Bottom line, you can finance a war economy on spreadsheets. You cannot hide a busted fuel market from drivers. When the port hits pile up and the central bank still talks about elevated expectations, the social ledger is already in the red.